Bonds have been historically bad over the past couple years. Is now a good time to start allocating to fixed income? And also, how should your portfolio composition change as cycles end?
This is InvestTalk. Independent thinking, shared success.
Good afternoon, fellow investors. Welcome back to InvestTalk. My name is Luke Guerrero, and today is Tuesday, June 18th. And I have an exciting, I hope, a good show for you today. We're going to be talking about a lot of things. We're going to be talking about hedge funds, exciting things about hedge funds. We're talking more about China, some stories we didn't get to yesterday. And most importantly, your caller questions, your YouTube comment questions, your iTunes questions, hopefully some of your live call questions, because after all, as I like to say, you are the one who drives the conversation and you move our journey of learning, our journey to becoming a better and more informed investor forward. That being said, we'll run down the market performance for today and talk about those show topics in a little bit more depth. But first, let's tackle our first caller question now.
Hey guys, I was calling about CNQ. I think you guys might have talked about being interested in it in the past. I was just wondering, after this stock split in this nice little pullback here, if now would still be a good time to get in. It's been on my watch list for a while. I've just been hoping for a nice healthy pullback like this. And also just to give my regards to Steve. I lost my mom to pancreatic cancer, so glad that he's found peace now. I know what a struggle something like that could be. So all my best to him and his family. Thanks, guys.
First, thank you for the kind words. We'll certainly pass those along to his family. But you are correct. CNQ is a name we've talked about before. That is Canadian Natural Resources. It is an oil and natural gas production company. Excuse me. And exploration company, development company. It operates in Canada. And the thing that we like about this company is it has pretty consistent and pretty good growth. So its 5-year annualized growth rate is 11%, which is lower than its long-term growth rate of about 12%. And there has been a little bit of a pullback. I'll push back on the after the stock split comment. Stock splits, people get worked up about stock splits. It's just a thing that happens on paper. Nothing really changes. Sometimes I guess psychologically people think, oh, it's cheaper, and NVIDIA is not trading at 1,200 anymore. It's trading at 120. I should buy it now. But in reality, nothing happens. But that being said, there has been a little bit of a pullback. Year to date, it's only up 8%. 3 months, it's pulled back about 4 to 5%. And so over the past 5 years on an annualized basis, it's outperformed its industry by about 2.3%. This is a name that has always been in the top half of performers going back at least the past decade in the oil and gas exploration space. And again, the reason why we like it is that growth picture, that 11%. For context, if you look at another large cap name, obviously this one's a little smaller than Exxon. It's only $71 billion in market value in US dollars. If you're watching this at home, you can see that this right here says 99. That's because that's in Canadian dollars. And so it's about half the size of Exxon, but its growth prospects have been a lot better. Exxon grows at, I think, about 4% over the past 5 years annualized. Again, this is at 11%. So that's something we really like. Now, their margins are going to be up and down because they're based upon the commodities that they're selling. But there has been some pretty good growth in profitability coming out of 2020 where they actually lost money. So you see their net margins coming out of 2020 into 2021, 25%. That's increased and projected to be, it's actually kind of flat, projected to be about 21% this year. Still great margins for this line of business. Their debt levels, modest, $9 billion of debt, again, on a $70 billion company. And so as the prices of oil have come down a little bit, so have their projections of earnings going into this next quarter. But their cash flow still is stellar. It's far ahead of where it was even 5 years ago. And in that time, they've bought back some shares coming out of 2021. And they pay a consistent dividend that has been around 4%. Around 3.5, around 4%. Their dividends per share has increased pretty consistently from the 80 to 90 cent range to 185 last year, projected to be $2.10 this year. Their dividend yield right now is sitting at about 4.4%. So, for me, I think this is a great business. Again, great growth potential. I think I've said that 12 times by now. And with this pullback, it's at a pretty modest price level. Price to book about 2.5, which tends to be, I would say, on the higher end of the oil and gas exploration names. Price to earnings only trading at 12. So, if you think that oil is headed higher, and that it has reached a local bottom, now's a good time to buy. If you think there's some production capacity, or that there aren't going to be production capacity constraints, as we've kind of seen over the past couple months, then maybe this will head a little bit lower. Either way, it's a healthy pullback. I'll say it one more time. Good growing name. We like CNQ. Thanks for the call. Now, we got a lot of ground to cover in the next 45 minutes or so, and here's some of what we have planned for you, time permitting. My main focus point concerns this story. It's been a terrible time for bonds, but should you own them now? Challenges in the bond market could set the table for stronger future returns. So in order to understand this, we'll talk a little bit about bonds, the bond market, treasury bonds, corporate bonds, and where you should be looking for yield within fixed income. We'll also talk about the complex hedge fund trades that are rearing their head, trades that are reminiscent of the credit default swap trades of the great financial crisis. And so what does that say about the risk levels people are willing to take in their trades and the sizing of these trades and some of the risks for the overall financial economy? We'll also talk a little bit about early repayment of loans in the Chinese housing market. What does it mean when homeowners, business owners, real estate owners in general are going to forego investing in other things in order to pay down debt early? What are the knock-on effects? What does it say about the Chinese economy? And towards the end of the show, if we have some time, we'll talk about the FTC, who is suing Adobe. That has certainly been something that has been consistent with the Biden administration, is going after companies that they perceive are spending, or rather are taking advantage of their customers. We also have some voice bank questions ready to play. One on EWW we didn't get to yesterday, the iShares MSCI Mexico ETF, and one on portfolio composition with regards to cyclical companies. We also have some questions that came in from the comment section of the InvestTalk YouTube channel. And of course, we welcome your finance and investment questions now on 888-99-CHART. With that being said, we're going to head into a short break, and on the other side, we'll talk about today's market activity, as well as take any of your questions. Like I said, feel free to call 888-99-CHART.
The stock market is constantly changing, and serious investors want a way to get the latest news and unbiased investment insights. Welcome to the InvestTalk podcast. You are invited to be part of our learning experience. Simply use the InvestTalk voice bank to record your finance and investment questions anytime, 24/7 at 888-99-CHART.
Let's talk a little bit about the market today. U.S. stocks ended higher. Once again, though, a bit off of their best levels for the day. The S&P locked in its 31st record high of the year. Big tech, mostly lower with the exception of NVIDIA, that surpassed Microsoft as the world's largest publicly traded company. Outperformers included energy, banks, insurers, telecoms. Underperformers looked like airlines didn't do too well, software, department stores. The dollar was pretty flat, gold finishing up almost 1%, around 80 basis points. Crude oil up 1.2%, back above that $80 a barrel mark. I would say overall, another uneventful session, lower volume session ahead of tomorrow's market holiday. May retail sales came in and really reaffirmed the weakness in consumer trends and growth concerns, and offered more support for a September rate cut, frankly. Prior months were also revised lower across the board, good for the rate cut case. May industrial production also came in that beat. It was a big day for Fed speak. New York Fed's Williams said that the 3% inflation was not the new normal, and the Fed will get inflation back to its 2% target. And there's also a Treasury auction today on 20-year bonds, about $13 billion in 20-year bonds, which was pretty well received. There were some fears given more recent auctions about if they could continue to see the demand they've been seeing. Dealers took a record low proportion of the offer, which is good for Treasury bonds. Also elsewhere, actually, one thing I want to mention is Bank of America's latest fund manager survey found that sentiment is the most bullish it's been since November of 2021. Looking ahead to Thursday, we have some jobs numbers coming in. Other than that, again, a really quiet week and a reminder once again that the market is closed tomorrow. Now let's shift gears and head to our InvestTalk YouTube channel. where we have a commenter who came in with a question. Remember that we are now available in video format, and we see comments section full of questions now for us. And so we like to get to those as soon as we can. This one about ticker HWKN says, I'm interested in getting your thoughts on HWKN. So let's see what I think. Well, HWKN is Hawkins Inc. And from what I know about this company, I know they've actually had a pretty rough Q3 and Q4 of last year, but regardless, incredible strength from 52 weeks ago. Over the past year, they've returned 83%, which is pretty phenomenal, and it's run up pretty significantly in the past 5 years. Actually, its relative strength has been pretty high relative to the S&P 500. And that's because its revenue growth is consistent. They're growing at about 10% annualized, which far outpaces their 6% annualized long-term growth rate. They bought back shares in the past 5 years, which obviously, if you know us, we like that. Their net margins have improved. Their cash flows improved. Their valuations, a little bit on the pricier side, though not too crazy. But for a company that is a distributor and manufacturer of chemicals and specialty ingredients for industry, a little high. So around 23 times forward-looking price to earnings, 4.6 times price to book value. I like this company. I've actually been watching this company for good reason, because their net margins have, like I said, been improving from 4.4% in March of 2018 all the way to what's projected to be 7.8% for a specialty chemicals company. That's fantastic. For me, it's a little too expensive. I'm keeping it on my watch list. And one thing that I will also point out about this company, if you're looking to buy it now, is that they are going to report earnings pretty soon, about next month. So I actually do have some time. There's a different company I was looking at earlier today that I mixed it up with. And I'll still tell the lesson, which is generally if you see a company that is reporting earnings within the next 2 weeks is not a good time to buy. There's a lot of speculation just related to beats or misses there. But anyways, Hawkins, I have it on my list, HWKN, but I don't think now is a great time to buy just because it's a little pricey for the type of business that it's in. Thanks for watching. Now let's fit in one more voicemail question that came in earlier to 888-99-CHART.
Hello, this is Selena from Minneapolis. I had a question about Mexico. I know you're big on Mexico, and I'm looking to maybe start a position in EWW, but I know that the recent the politicians that have been elected have caused investors to step away from investing in Mexico. I was just wondering what your thoughts were, if you think that the new political climate is in fact going to change their future economic situation, or if this is a good opportunity to enter into the position. Look forward to hearing your answer on the podcast. Thanks for all you do.
So before we talk about my opinion on what the situation in Mexico, let's talk about the fund itself and see if that would be, if you wanted to get some exposure to Mexico, a good way to do it. So EWW is the iShares Mexico ETF. It's a passively managed fund. It has vanilla exposure to the Mexican stock market, and it has an all cap. It's an all cap, so it holds large caps, small caps, mid caps. It's about 45% large, 30% mid, and 5% small. It just follows the index. And so, it's got market-like exposure, consumer non-cyclicals being the largest, then finance and non-energy materials. And it does all of this for you for about 50 basis points, which is not too expensive. Again, you're going to have to pay more to go internationally generally, and you're going to have to pay more to go outside of European economies and the US generally as well. And so, taking a look at markets tend to like consistency, right? So if you look at the US, for example, historically, markets have done best with Democratic presidents and Republican Congresses because it essentially results in the status quo. And so within Mexico, what you have is a continuation of the previous leadership, such that there probably is going to be on the same path. And regardless of what current leadership is, essentially investing in Mexico, which is one of our largest trading partners and one of the best success stories of foreign aid, which I don't even have time to get into. But investing in Mexico and a lot of international markets now is banking on the fact that they have done poorly relative to the US because of how growth has been in the past 2 years. And so when this starts to bottom out, I would say this is actually a good time to start to invest in Mexico and other parts of the international market that have been left behind over the past year. Thanks for the call. Now we're headed into another short break. Still to come, more answers to caller questions and a discussion about bonds. This is InvestTalk. Feel free to call anytime at 888-99-CHART.
Thank you for watching. Make sure you like, subscribe, and hit the notification bell so you never miss an episode of the InvestTalk podcast.
Did you enjoy our insights on InvestTalk? Great news. Our podcast is available on all major platforms. Make sure to subscribe wherever you listen to your podcasts and get the latest in investment advice across Spotify, Apple Podcasts, and more. Subscribe now and join the community of informed investors. Let's go to Art from Menlo Park, California. You have a question about FTNT. Do you own it or are you looking to buy it?
I'm looking to buy it. And I just wanted to make a comment on Steve. Sorry to hear about Steve, and send some condolences to his family and also the office.
Yeah, we definitely will. Thank you. But let's carry on Steve's work and answer this question for you. And so that's on FTNT, which is Fortinet Inc. And it's a cybersecurity solutions company. It's a software company. And it's had a pretty big pullback over the past year, especially relative to tech as a whole. It's down about 18%. And that's after having a significant run-up since 2018. So its relative strength relative to the S&P is very, very strong. And a lot of that is due to its revenue growth, about 24% year over year for the past 5 years, far outpacing its long-term growth trajectory. And that has brought this company to the ranks of the large caps. It's about $46 billion. And with that, it has about $1 billion worth of debt. So nothing too crazy there. Short interest looks fine, does not pay a dividend. Its cash flow has been steadily improving. If you could see my screen, it's pretty much a straight line up and to the right. So that's certainly a good thing. Profitability has been improving as well. Their net margin moved from about 18%, then down at the low in 2019 to 15 to 2023. It was around 21%, projected to be 23% this year. You know, for me, I think the issue I have is that I was looking at this company earlier in the year, when it was trading pretty flat relative to where it is now. It's year to date, it's only up 1%, and still, I think that for a company that sells cybersecurity solutions to businesses, it tends to be more cyclical, and all of the signs are still pointing to a pullback within corporate spending. And not as steep as a lot of people would have thought, but certainly the economic data is deteriorating a little bit. And one interesting thing I saw today, which isn't related to this company, is that for another day where the NASDAQ and the S&P 500 are notching new highs, more companies are hitting their 52-week low than their 52-week high. So I think a lot is being masked by what an index is showing because a couple names are doing very well. And so you saw a little bit of a pullback in its growth from 2022 into 2023, only growing by about 900 million. That's supposed to pull back even more this year. That's why it's still falling a little bit. So for me, given the growth dynamics and the sales dynamics and the cyclicality of the business, I don't think you should be buying a company that's trading at 22 times its price to cash flow in this kind of environment. I think it's a good business. I think, again, cash flow up and to the right is beautiful. Shares being bought back is fantastic. Earnings being upgraded, profitability improving is great. But I think that it's still a little bit too expensive. So it's still on my watch list. I think it should still be on yours. Thanks for the call. Now let's shift gears and talk about bonds. We talk a lot about stocks here. And because of that, we want to focus a little bit on the fact that it's really been a terrible time for bonds recently. And what does that say about if you should own them now? Because challenges in the bond market may have set the table for stronger future returns. And so let's talk a little bit about the bond market. Because bonds have traditionally been considered a safe, stabilizing force in investment portfolios. But the recent prolonged downturn in the bond market has kind of challenged that view. It's been nearly 4 years since the bond market saw a new all-time high, marking what some believe to be the toughest period in bond market history. And this ongoing drawdown is reflected in record inflows into cash as investors seek safer returns, indicating a general capitulation from bonds to cash in the wake of local highs in treasury yields. However, abandoning bonds now might be premature. Historical data shows that the bond market's performance, like anything else, is cyclical. Therefore, the current low might set the stage for future gains. For example, bond yields were particularly low in July 2020, making the prospects for significant returns pretty bleak. Since then, rates have risen, particularly during an 18-month tightening cycle by the Fed, which could lay the groundwork for more favorable bond returns ahead. The challenges lie in predicting these future movements in interest rates, which is notoriously difficult. Despite predictions at the start of the year that rates would be cut as much as 7 times, the opposite has occurred. Outside the Treasury yield, the benchmark rate rather, yields have been increasing. Now, the unpredictability underscores the risk of relying too heavily on any single market scenario. Given these conditions, a diversified approach remains prudent. Investors should consider balancing their bond portfolios across various maturities and types, short-term, intermediate-term treasuries, maintain exposure to different credit sectors. Different sectors are going to be exposed differently to risk. Corporate bonds, they're currently offering pretty limited excess returns due to high prices. Sectors like agency mortgage-backed securities, for example, and emerging market debt look more attractive with current yields, but you have to keep in mind that there are going to be higher risk levels with that as well. Ultimately, the recent difficulties in the bond market don't really signal an end to the viability of bonds as an investment, but instead, what it really does is it highlights the importance of strategic, informed portfolio management that prepares for a range of outcomes and adjusts as conditions evolve. Now, on the next Invest Talk, we'll look into this topic, the psychology of retirement income, from saving to spending. Are you lost in the retirement consumption puzzle? We'll dig down into that story tomorrow, but for now, I'm Luke Guerrero, and we're ready to take your calls live on 888-99-CHART.
Love today's InvestTalk episode? We want to hear from you. Drop your investing questions in the comments below, and your question could be the star of our next segment. Subscribe and stay tuned to see if your question gets answered by Luke and I. Dive into the comments now and become a part of our next conversation.
Looks like I got a little bit ahead of myself and forgot what I'd already mentioned earlier, which is that tomorrow is a federal holiday, which means markets are closed, and we will be taking the day off and instead running a fresh Best of Caller Questions podcast. So look forward to a discussion about retirement psychology on Thursday. Now let's go to Jordan in Dana Point, who has a question about PRIM.
Yeah, hey Luke. I own PRIM. I've done pretty decent. Just wondering if you would sell, hold, or buy more.
Yeah, so let me ask first, what percentage would you say that is of your portfolio?
Like 2%.
Okay, so nothing too crazy. Sounds good. Okay, so let's dig into this. So PRIM engages in construction, maintenance, replacement, and engineering services. It's an engineering services company, construction company. They've done very well over the past year. I imagine you've been holding on to it for a good portion of that, and that's because they've been up 87% over the past year. And a lot of that is due to their growth. In a time where you don't see a lot of construction happening and people are pulling back, they still are managing to grow the revenues from $4.4 billion in 2022 to $5.7 billion in 2023. That's projected to be $5.9 billion this year. So slowing down a little bit, but still 5-year annualized growth rate sits at about 14%, same as their long-term growth rate. And a lot of that's been converted to cash flow, which really is the most important part, right? Cash is the lifeblood of the business. So that's been growing consistently since 2022. And their margins are exactly where you'd expect them to be in this type of business line, about 2 to 3%. So nothing alarming there. Now, one thing that is a red flag, if you will, is they have a decent amount of debt. It's a $2.83 billion company. They got $1 billion in debt, but it doesn't seem like that's much of a weight on their income because they're only about 4 times levered on times interest earned. So nothing too concerning. Their earnings have been upgraded consistently over the past year. And yeah, not a lot of short interest, consistent dividend they've been paying over the past 5 years. Have they been improving that dividend? No, it's been around 24 cents per share, which they haven't been issuing any shares. So that's been pretty consistent. All this is looking good. So the next question I have is, what are its relative valuations here? So it's trading at 2 times price to book. It's trading at 15 times forward-looking earnings. No, I mean, this is a well-run business, it seems like, that's been growing consistently in a time where probably its competitors have not been growing that consistently. On a 5-year basis, they've underperformed the industry, but that certainly hasn't been the case over the past 2 years. They outperformed by 17% in 2023. They're outperforming by 41% this year. I don't think it looks too expensive. I think the reasons why this company is doing well is because they had a little bit of a turnaround in terms of their revenue growth, especially coming from some flat years in 2018, 19, 2020. And they're certainly growing more robustly than the rest of the industry. So, 2%, I would certainly hold on to it. I don't know if I'd buy more, but I'd certainly hold on to it. I don't see any reasons to trim. I don't see any reasons that it would start to rotate in the near term. So long as, it looks like they have, earnings is until August. You're probably going to have some pretty muted volume. But overall, it looks like its relative strength has been improving. Again, it looks like a well-run business and it's on the right track. So definitely a hold on to it for now, I would say. Thanks for the call. Now let's shift gears and talk a little bit about a more complex thing, which is that earlier this year, Bayview Asset Management engaged in pretty significant financial transactions, and that they did a deal worth $642 million with 2 U.S. lenders. So this wasn't just a normal trade. It was a structured deal, which was remarkably similar to those seen before the 2008 financial crisis. Now, this transaction involves selling credit default swaps to Huntington and SoFi, and then redistributing much of this risk to investors through resecuritization. Now, that sounds complex, so let's take it piece by piece. A credit default swap is essentially like an insurance policy. And so you're paying a premium, and if the underlying asset defaults, you get a payout. Now, you don't even have to own the underlying asset, which was one of the issues with 2008 is that there was counterparty risk. The people that wrote those credit default swaps couldn't pay it off. So then when a lot of mortgages failed and the resecuritized products failed as well, a lot of people went under. So like I said, such financial maneuvers kind of echo the complex practices of the past. The collateralized debt obligations, which contributed to that turmoil that I mentioned. But despite the controversial nature of these transactions, the current deals appear to, in part, incorporate more safeguards. They have upfront cash requirements, which mitigates that counterparty risk. Again, that was one of the big issues in 2008. And so this resurgence in really complex financial products comes amid growing demand for high-yielding investments and an expanding what we call the shadow banking sector. Now, some observers are voicing concerns, justifiably so. After all, these deals may obscure underlying weaknesses in the banking system and pose a lot of governance risks, especially involving lightly regulated non-banks within that shadow banking system. Now, calls for more transparency around the use of credit risk transfers, CRTs is what they're calling them, are growing. Some are urging regulators to require these banks to disclose more about their engagement in such transactions. But the structure of the recent deals by Bayview involved creating bonds from the CDSs sold to the banks and then selling parts of the risk to other investors, meaning that you're taking these assets and they're being proliferated across the market and exposing maybe people that don't fully understand them, which is always an issue. For example, Huntington and SoFi make regular premium payments, this is how these work, which are part of the security for the bonds issued. The structure involves a cash collateral account to further secure the transaction backed by letters of credit from reputable banks like Goldman Sachs. But keep in mind, oftentimes where there are financial issues within the system, reputable banks are the ones that have been saying everything's okay. And so these measures are intended to certainly reassure investors and stabilize the products, especially in the wake of what happened almost 2 decades ago. But nonetheless, the revival of such complex financial instruments indicates a return to risky practices that require, in my opinion, very careful oversight and regulation to prevent potential systemic risks. Let's head back over to our YouTube question bank. This one came in from Carter, who had a question about FAST, F-A-S-T. Is it a buy after its recent pullback? So Fastenal is exactly what it sounds like. They make fasteners and tools. They distribute fasteners and tools. They operate hardware stores as well. And it has had a recent pullback in the past 3 months. It's down about 14%. So let's take a look at its income characteristics, its fundamentals. Over the past 5 years, it looks like they've had an annualized growth rate of about 8%. Pretty good for this type of business. How's that gotten to their bottom line? Their net income has grown. Their net margin has been pretty consistent. It's been around 15 to 16 for the past 5 years, which is certainly good, especially for this type of business. But you haven't seen any growth or cost reductions there. So that's important to note, given that growth is only around 8% annualized. And it's kind of tapered off a little bit from 2022 into 2023. They didn't grow as much, for example, as they did in the preceding 3 years. So that may in part be what is contributing to the pullback as well. And so, they've bought back a bunch of shares in the past year. Their earnings have been upgraded now. They have very minimal debt. It's a $36 billion market cap company, only $500 million in debt. So all that looks good. Their cash flow is improving, minimal short interest. They pay a dividend. Consistent dividend, usually around 2 to 3% dividend yield. And they've been increasing that dividend over the years. Again, all good things. But it's trading at a forward-looking PD of 30 and price to book at 10. This is far too expensive. This is another one you need to keep on your watch list. It's a good business. It has a consensus rating of hold, and for good reason. It is trading far too expensive for what it is doing. Thanks for the comment. Let's move it back to the InvestTalk voice bank for a question that came in earlier to 888-99-CHART.
Hi there, Duncan from New York. Thank you for all that you do. I'm giving a call about stock ticker VEGI, VEGI ETF. I've had it for about a couple of years now. It's been done pretty decent. I think I want to sell it. It's not performing as well, and I want to actually move the cash towards other profitable businesses such as energy, or maybe Cameron, that CCG, the nuclear. I just wanted to know your 2 cents, whether I should get out of this ETF as soon as possible, and what should I do with the cash, either invest it in another ETF, a dividend ETF, or an energy ETF, or that CCG, Cameron nuclear power plant. Thank you very much, and have a great day. Bye.
So a lot of questions embedded there. So let's just stick to one, which is, what were my thoughts on VEGI? Should you get out of it? And then what you do with it afterwards is certainly should be predicated upon what your overall portfolio looks like. So VEGI is a commodity production agricultural ETF. It's exposed to fertilizers, agricultural chemicals and products, farm machinery. And so it just looks at the GICS sector classification and does a market cap weighted approach, I imagine. Yeah, market cap weighted approach. Yeah, market cap weighted approach in U.S. businesses. And so because of that, it has about 59% in large caps, 30% in mid caps, and 9% in small caps. It's kind of difficult to say how that tracks the overall market, because I'm not sure that there's an index that really tracks this specific part of the market. But either way, that gives you good exposure to non-cyclicals, industrials, and non-energy materials. And so, I think that personally, with the run-up you had about 2 years ago, and the subsequent downtrend relative to the overall market, I think this is probably going to continue to head down a little bit. And so, I think this would be a good time to get out of it. And you mentioned some businesses like energy. You mentioned, renewable energy, nuclear energy. You mentioned, and energy valuations have actually come down a little bit in the past couple of days as the price of oil has fallen as well. So there are some good buying opportunities there. But either way, I think this is probably going to continue to head downward. There's been a pretty consistent downtrend relative to the overall market going on past 6 months now, so probably going to continue to head lower. Thanks for the call. Whenever possible, we like to play 2 in a row, so let's listen to another caller question now.
Hi, Justin or Luke. I'm calling with a 2-part question. The first one has to do with portfolio composition. I was wondering what you guys do in a situation where I've noticed I'm buying for the last year, I've been owning a lot of energy, cyclical companies, gold, metals, mining, industrials. When the cycle is over, whenever that is, I do plan on holding it medium term, and I start selling out of those companies. What do you do as far as portfolio composition? Do you just keep the blue chip companies in your portfolio, or do you start buying growth in other companies ahead of time so that when you start selling out of those cyclical companies, you have a portfolio that is more set for the long term? And that kind of leads me to my second question, something like Amazon. If you can look into the company and you would start, investing in something like that early and ahead of time, or would you, wait for a further pullback or wait for your portfolio to sell out of some of the cyclical companies? I hope that makes sense. If you can just let me know more about portfolio composition and what you do when your portfolio is heavy into the cyclical companies. Thank you. Have a good day. Bye.
Okay. So I'm going to stick to the first part of this question as well, which is about portfolio composition and what to do with cyclical companies. So I think I've talked about this before. And one of the issues with taking deviations relative to the market in terms of sector differences is you add on a type of risk we call tracking error, right? Because wealth, in a way, isn't just about nominal dollars that are returned. It's about relative dollars returned, right? If you are gaining $100 and everything else is becoming 1,000 times more expensive, you're not really gaining $100. Now, that's an inflationary idea about how the worth of the dollar is in its purchasing power. But in the same way, your wealth is relative to how the market's returning. And so what we're talking about here really is a risk mitigation technique, which is what I do and what we do is we take a look at the overall market that we're trying to invest in and see what the sector exposures are. And from there, in order to protect against some of that risk of taking too far deviations, create bands. Say you don't want to be more than 10% overweight or underweight. You don't want to be more than 5% overweight or underweight. And so when you're taking a look at where you stand relative to the business cycle, if you're trying to get out of some of those cyclicals, this should go back to your portfolio constraints. What are your most overweight positions relative to what your targets are? Those are the ones you want to trim first. It may not be that you want to hold on to all large caps because they're blue chips. It should be that you want to hold on to the best businesses that still have the potential to grow. And so first and foremost, you would probably want to cut down on your overweight names. And then you'd want to toss out anything that is relative to the other names, less likely to have the potential to appreciate in price and grow as a business. And so going back to the first point, if you keep in mind when you construct portfolios, strict guidelines to mitigate risk and you stick to those are the situations where you tend to have the best outcomes. Thanks for the call. Now let's see if we can preview another question before we head into the break. I'm not sure if we can do it. You tell me, guys.
Hello, I had a question about ticker LEA. The company is Lear. I currently hold a 1% position, down about 30%, and wanted to see your insight as to whether I should add to it, hold, or sell it. Thank you. Bye.
So Lear, before we head into the break, we'll just briefly describe this company. It designs, manufactures, and supplies automotive seats, electrical distribution systems, and electronic modules. And it does so, geographically speaking, all over the place. 21% in the United States, 31% in Europe, 15% in Mexico, and 34% in the other categories. Its performance, which is the last thing we'll talk about before we head into the break, in the past 52 weeks, it's down 20%. Most of that year to date, it's down 18%. 5-year relative strength has been kind of falling consistently downward. So when we head back from the break, we'll talk about its fundamentals. We'll talk about its relative valuations, its growth prospects, and whether or not we think Lear is a good company to continue to hold. I'm Luke Guerrero. This is InvestTalk. This is our last break, which means if you want to get your caller question in live, call now at 888-99-CHART.
Hey, welcome to InvestTalk. I'm Justin.
And I'm Luke. And together, we're your guides through the maze of investing. We'll bring you insights that will impact your portfolio.
Whether you're a seasoned investor or just getting started, we've got you covered with the latest trends, opportunities, and expert advice. We take your calls every weekday at 4 p.m. Pacific and on our anytime listener line at 888-99-CHART.
We'll bring you deep dives into market analysis and answer your burning questions.
So why join us? To get ahead in your investment journey with strategies, tips, and knowledge that will help unlock the full potential of your hard-earned money.
But first, hit subscribe and turn your notifications on, and let's make informed investment decisions together.
Welcome to InvestTalk.
So before we headed into the break, we were previewing a question about Lear Corporation, LEA. They are a manufacturer and supplier of automotive seats and electrical distribution systems. We mentioned that they have customers all over the place. Revenue is pretty evenly split between the United States, Mexico, Europe, Africa, and this other category. And the reason why they've been falling off is because growth has really fallen off in the past 5 years. Their long-term growth rate's around 23%, but in the past 5 years, 2% growth. And so you even see here, like this 5-year trend in relative strength, it really started to diverge from the S&P 500, and it certainly hasn't really recovered much. Again, in the past year, it's down almost 20%. Year to date, it's down almost 20%. It was down 1% today. And because of that, it's trading at a forward-looking price earnings of 7, which is very low. Its price to book is of 1.3, also very low. And through all this, their margins have improved a little bit, but not really. They've improved since 2020. They used to be about 5.4%. Then in 2020, they got all the way down to 90 basis points. Now it's back up to 2.4. It's supposed to be 3.3 next year. Their return on assets and return on equity is comparably low to other companies within the industry. And if you look at their price performance charted in the past year as this loads, I can tell you from another screen that it's a consistent downtrend over the past year. And it recently broke more support. Here you go. This is the past 3 months. But let's pull it back to a 2-year basis. And you see there's some pretty strong support at 120, and then it started to break down. Now it's heading even lower. So, I think the business had done very well, it looks like, over the long term, going back maybe 10 years. But within this 5-year time frame, it's been really struggling. It's underperformed the industry consistently, not that much, only about 1.2%, but still underperformance. And I think the real problem here is hindrance to sales growth. And so when you're not improving margins that much, and when you're not reducing on costs and your revenues aren't growing, it's not very attractive to investors. And so as this continues to break down, I wouldn't hold on to it. I think your capital is better used elsewhere. Thanks for the call. Now, before we head off into the weekend, I want to touch on one more topic, one that we tried to preview yesterday, and that was the Chinese property market. And so, China's residential mortgage-backed securities market has significantly contracted, as you all know. We've talked about it a lot. It's actually decreased by almost 2/3 over the past year. It's dropped from over 1 trillion renminbi to 363 billion. Now, this reduction is largely due to a wave of early repayments by property owners. In March, the prepayment rate reached an annualized 43%. For context, that's about 4 times what that number usually is. So why is this happening? What does it mean? Well, let's think about it. Let's think about why we don't pay off lower yielding debt. People call all the time, say, I want to pay off my mortgage. And those are the people that were lucky enough to have the 2-3% mortgages. And you have to tell them, well, if treasuries are yielding 5, you can get 5 in SGov, you can get 4 to 5. Why would you ever do that? Right? So the reason why you don't pay off lower yielding debt is because there's better investment opportunities elsewhere. So what this is telling us is that domestically, households see a lack of appealing investment options within China. And this phenomenon's affected the securities industry as well. Assets are bundled and sold to investors. Investors in mortgage-backed securities are facing one of the primary risks of those instruments, prepayment risk. Early repayments are now compelling them as well to seek alternative investment avenues to maintain similar yields. The absence of new mortgage-backed securities because of all of this since 2022 underscores the downturn even more in housing. And really the broader investment challenges within China itself. And so experts at the S&P Global attribute the high prepayment rates to the broader property market's challenges, something that has dragged down the Chinese economy overall, and increased sales of existing homes rather than new builds, right? When the property market fell, so did a lot of these construction companies. And that further emphasizes the economic pressures influencing homeowners and investor behavior in China as a whole. So as the signs keep coming in, it appears that the Chinese economy is far from out of the woods. Now, I'm Luke Guerrero. This completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family members about our free podcast downloads. Get yours anytime at iTunes, Google Play, and Spotify. And I hope you've heard that the InvestTalk podcast is also available in video form on our YouTube channel. Search InvestTalk with 2 T's. We post it every day. We have some webinars over there, really interesting content that I think can help you out. So go check that out. As another reminder, tomorrow, Wednesday, June 19th, is a federal holiday, so we will have a Best of Caller Questions podcast, and we will come back ready to answer your finance and investment questions on Thursday, 4 p.m. Pacific. Independent thinking, shared success. This is InvestTalk. Enjoy the holiday.
Hey everyone, if you enjoyed this video and want to see more amazing content, make sure you hit that subscribe button and turn on notifications.
Your support means the world to us and helps us create more videos that you love.
Subscribe now and join our community of savvy investors.